Good morning. I'm Joe Malandrino, Global Markets Reporter at Nasdaq. And for this edition of Trade Talks, we're going to jump back into the commercial real estate space with Tony Barkan. He's the founder and chief investment officer of Allegash Partners. Tony, as always, thank you for joining me at MarketSite. I just want to run through some quick numbers and refer to my notes because these are some big numbers here. The last time we spoke, you thought the best opportunities in the $16 trillion commercial real estate market might lie on the debt side, with about $2 billion, and you also thought about another $200 billion in additional capital might be needed to fully see this investment through. So what I want to discuss today is the difference between debt and equity investing.
Sure. Thanks for having me.
Of course.
And I think it's worth stepping back a little bit and talking about commercial real estate because people have a good understanding of residential without necessarily understanding commercial as well. Commercial real estate is really more like corporate finance, and we borrow a lot of our terms from corporate finance. So, for instance, we don't have the owners the way you do in a house. You've got sponsors. All the properties are held in special purpose companies, and they're measured by their net income. So you really have a situation where it's more like running a company with profitability. The leverage is also more like the leverage in the corporate finance market, where you've got senior debt and then mezzanine debt, and finally preferred equity and then the common equity, which is what's owned by that sponsor or general partner. And the general partner will raise money from limited partners as the process gets bigger and as the properties get bigger. What we see a lot is that there's less debt, in fact, in the commercial real estate market than there is in the residential real estate market. Right now, the commercial real estate market is as you said, $16 trillion market. It's got about 25% of that in debt, as opposed to a $30 trillion residential market, which is about 50% debt. Residential mortgages are self-amortizing, so almost all properties start with debt and then wind up without debt, whereas in the commercial real estate market, about 50% of the properties start out with some debt. And a lot of the very small properties, in fact, don't have any debt at all. It's really the larger properties that look for the most debt as they're run by the more professional managers.
Now, you also mentioned sponsors. Are there different types for different kinds of properties? And historically, who have been those types of sponsors? And on back of that, who have been the lenders?
Sure. The sponsors, well, if we start with the smallest properties, the sponsors in the smallest properties really are local people. We all know doctors and storekeepers that own their offices and shops. And for the smallest properties, the ones that very often aren't levered at all, those are just part and parcel of the businesses that people are running, and they own those properties. As you get to slightly larger properties in slightly larger cities, you get more professional, you get home builders, or rather just builders, developers, and professional equity firms that are running larger companies. And finally, when you get to the largest properties in the largest cities, you get the large institutions. You get insurance companies, you get other financial institutions, REITs and the like, who own these and very often are getting investors to help them buy these multi-billion-dollar properties.
Right, so it sounds like they've done well here, as you mentioned. Do you think there's more of a significant opportunity on the debt side still at this point? Is that over, or has that been overextended?
I think we've got to go back to what we were talking about last time I was here, which is the story of the haves and have-nots, to really understand that, because I think that there's a big differential between those, certainly on the equity side as well as on the debt side. On the equity side, if you look at the haves are the gateway cities that ring the country, and the largest properties are measured by what we call cap rate in the business. And the cap rate is that net income of the property divided by the property value. Generally, that's the yield of the property, and that yield has been anywhere from 300 to 400 basis points historically over treasuries. Today, the absolute yield is down at around 300 basis points, or 3%. So you've got it incredibly tight to treasury rates in general. You've got valuations that are very high, and that has driven the indices very, very, very high. As a result, what you see is people talking about those properties and about how well the market is done, but the opportunity is not as great there because you've got yields for those properties so low. There's no longer a great expectation of total return for them. And as a result, even when you lever them up, you're really left with like a 5% return. As opposed to the have-nots, which is the center of the country, where cap rates are still trading in 6 to 8%. When you lever those up in a similar manner, even though it costs more to lever them, and it may not be quite as aggressive, you can actually get to a 10 to 12% yield for investors, which is quite good. Now, they have to pay the GP of the property, so the investors who are investing, the limited partners in that property, are probably taking home around 10%.
Well, 10% or even high single digits, it's not really that bad for a return, especially in today's markets. Do you think the debt side is much better than that?
You know, I think we should start with risk, because really the differentiation between debt and equity starts on the risk side. And when we talk about the large properties, the ones that are quite honestly less compelling today to own, we don't worry about risk as much. You know that if you buy an office building in New York City, it's probably professionally run. It's certainly going to have a market for it at some price. And so you worry a little bit less about risk. It's okay, you can invest more money in one property and you don't have to be as diversified. If you're going to move to that smaller secondary, tertiary market type property, you've got significantly more risk. You've got to try and find the properties. You've got to worry about who the sponsor is for the property, and is the property going to be managed well. You have to honestly worry about the building itself. When was it built and how's it doing? That's a lot of risk to build up. And the market isn't really developed to have people who are offering portfolios to diversify that risk out. So you're left trying to pick and choose in a difficult market. On the debt side, it's much easier to create a diversified portfolio. Now, you do have to work with a manager. You have to have somebody who can professionally pick out the better opportunities, but the marketplace as a whole is set up so that a diversified portfolio can be created. And just by definition of being in debt, you're moving up the capital structure, and so you have less credit risk. So the question is, how much, if anything, do you have to give up in terms of yield relative to that 10% take home for the equity side of the portfolio if you're going to get that better credit position? And when we look at the marketplace right now, and I'll just use mezzanine debt as a proxy for the marketplace, also because I happen to think it's the most compelling opportunity, we've seen mezzanine debt trading between 8 and 12%. So when you take that, you create a portfolio, you add a little bit of external leverage, investors actually have the opportunity to take home 12 to 16% net returns in a fund that's investing in the mezzanine part of the capital structure. And so as a result, they're getting a better credit profile. They're getting the same, if not higher, returns. It seems like a pretty compelling argument for
Well, let me ask you this. Can individual investors actually take advantage of this? And why do you think individual investors tend to sway towards the equity side versus the debt side?
I think real estate is one of those assets that people like to get their hands dirty. They like to own it. They're used to owning their home. And so when they think about it, they like to own real estate. They want to own the property. And I can understand that. And certainly on the debt side, we're talking about a financial asset. And the last 10 years have not been a tremendous proof statement for the value of financial assets. Or maybe the crisis wasn't. The last 10 years, there's subsequently been a good rally. But I think that in general, people like to talk about the properties they own. But I think they're thinking about it a little off key. If you want to get involved in technology, you wouldn't necessarily go to school, get a degree,
right,
and build your own company from scratch. You would invest in a stock where there was a professional management team that were looking at technologies, finding products, and building it. And I think that commercial real estate debt is the same way. If you find a good manager who can pick properties, you can wind up with a very compelling portfolio. And so I think historically you've got a little bit of push because there aren't that many managers who are doing that right now. But I think that's going to grow. The opportunity is huge. And so I think the marketplace is going to grow in general.
It's a great way to look at it. Makes it much easier to understand. Thank you as always, Tony, for joining me. And traders, as always, thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.